Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Dear students, my name is Professor S.C. Sardar, faculty member of SD School of Commerce, Gujarat University. Friends, today we are going to study one of the important chapters of cost accounting as well as management accounting. The name of the chapter is Marginal Costing. Friends, this module is specifically prepared to explain the concept of absorption costing as well as marginal costing. As you know that absorption costing is known as total costing, and at the same time marginal costing also known as variable costing. First of all, we should try to understand the meaning of costing. What is costing? Costing is nothing but cost determination of product manufactured and service provided. Cost determination of product is very important for pricing decision. There are two different methods which are used to determine the cost of service and product, that is absorption costing and marginal costing. Friends, now let us try to understand what are the components of cost. Let us understand all these components. Friends, these components are categorized into two categories: direct cost and indirect cost. Indirect cost is known as overheads also. In case of direct cost, we include direct material, direct labor and direct expenses. Please keep remember that these are all variable cost. Now let us see the components of indirect cost. First is factory overheads. Factory overheads can be variable as well as fixed. Second is administration overheads, can be variable and fixed. While third one is selling and distribution overheads, which can be variable as well as fixed. But you keep remember one important rule for this, that overheads basically are fixed, but this can be in the variable form too. Dear students, we have obtained information about different components of cost. Now, how to apply all these components in case of marginal costing as well as absorption costing? There are total 8 elements we have taken into account. Out of this, we will confine to direct material, direct labor, direct expenses and variable factory overhead in case of marginal costing. But when you are going to determine the production cost in case of absorption costing, we will consider direct material, direct labor, direct expenses, variable factory overhead and fixed factory overhead. In both the cases, in marginal cost and in absorption costing, we will not include administration overheads as well as selling and distribution overheads. As we have obtained about different cost components, now these cost components can be categorized into two categories: product cost as well as period cost. Now friends, the product cost determination is very important. Product cost has direct relation with the production. If there is a production, there will be cost. No production, no cost. There is a direct relationship between these two variables. In this case, we include direct material, direct labor, direct expenses and variable factory overheads are the part of product cost. Second cost is period cost. Irrespective of production level, this cost is to be incurred by the organization. This cost will not become the part of inventory. In this cost, we can include selling and distribution overheads. Friends, now let us try to understand the classification of product and period cost under absorption costing and marginal costing. As we know that direct material, direct labor, direct expense and variable factory overheads are product cost under absorption costing and marginal costing. There is only one point of difference between absorption costing and marginal costing is to consider fixed factory overhead as a product cost in case of absorption costing, while in case of marginal costing it is considered as a period cost. While rest of the costs, variable administration overhead, fixed administration overhead, variable selling and distribution overhead, fixed selling and distribution overheads would remain same in both the system as a period cost. The point of difference is only for fixed factory overhead, that in absorption costing it will be treated as a product cost, while in marginal costing it will be treated as a period cost. Dear friends, absorption costing as well as marginal costing both are used to determine the cost of a product as well as services. The basic difference between absorption costing and marginal costing is regarding cost determination. Now let us acquire information about absorption costing. When you are going to determine the cost of a product under absorption costing, at that time you have to consider fixed factory overheads. Here variable overheads will be included, as well as direct material, direct labor and direct expenses also will be taken into account. Under absorption costing system, the product cost determination will be done as follows. Here you have to prepare income statement. Under income statement, the first item is your total sales value. Here selling price is to be multiplied with number of units. From that we have to deduct the cost of goods sold. Cost of goods sold is considered as a production cost. In this cost of goods sold, the first item is direct material. Direct material is to be calculated with the rate per unit and multiplied by number of units produced. Second cost is direct labor, rate per unit multiplied by number of units produced. Direct expenses, rate per unit multiplied by number of units produced. Variable factory overheads, rate per unit multiplied by number of units produced. And last is fixed factory overhead based on recovery rate multiplied by number of units produced. Get the total of all this, you will get the cost of production. It is possible that in the business organization there can be a opening stock as well as closing stock. Here we have to add the value of opening stock, get the total of cost of production and opening stock. From that you deduct the value of closing stock. That total amount is to be deducted from the sales value and you will get unadjusted profit. Friends, you will have question in your mind that why it is called unadjusted profit. The further explanation is given later on under the head of recovery rate. Friends, here if you have under recovery, it is to be deducted from unadjusted profit, and if you have over recovery, it is to be added in adjusted profit, and then finally you will get adjusted profit. After having adjusted profit, we have to deduct non-production cost. Non-production cost is comprising of variable administration overhead, fixed administration overheads, variable selling and distribution overheads, fixed selling and distribution overheads. Get the total of these four costs and deduct it from the adjusted profit. After having this deduction, whatever amount is arrived is known as net income and it is known as earning before interest and tax. What is recovery rate? In case of absorption costing, the determination of recovery rate is very significant. Let us try to understand the significance of recovery rate. For example, in your business organization, your installed capacity is for production of 1 lakh unit. If there is a demand of less than 1 lakh unit, that could be 80,000, 90,000. In this case, we have to determine our normal production capacity, keeping in mind the effect of all other external factors. If our demand is of 80,000 units, we have to recover our entire fixed factory overheads by producing and selling 80,000 units. We cannot consider our installed capacity of 1 lakh units. Therefore, the normal production capacity determination is very important. To determine recovery rate, the following formula can be used: fixed factory overheads divided by normal production. When there is a case of recovery rate, we have to understand two terminologies: under recovery and over recovery. First of all, let us try to understand what is under recovery. Friends, when our actual production is less than the normal production, in this case our recovered fixed overheads will be less than our actual fixed factory overhead. It is called under recovery. Let us try to understand this under recovery concept with the help of one practical problem. For example, our fixed factory overhead is of rupees 5 lakh and our determined normal production capacity 1 lakh. In this case, our recovery rate is rupees 5 per unit. So, here actual production, assume that we have 90,000 and our actual cost is of 5 lakh rupees. So, we have produced only 90,000 units in place of 1 lakh units. So, there is a difference of 10,000 units multiplied by 5 rupees, that is 50,000 rupees. So, difference of 50,000 rupees is known as under recovery, which will be deducted from our profit as we have observed in our cost sheet of the previous slide. Now, let us try to understand what is over recovery. Over recovery is just opposite to under recovery. When our actual production is more than normal production, in this case the question of over recovery would arise. Question is same, our fixed cost is of rupees 5 lakh, normal production capacity we have determined 1 lakh, assume that our production is of 1 lakh 5,000. So, in this case our total collection will be of 5 lakh 25,000, but our actual fixed cost is of only 5 lakh rupees, and therefore the 25,000 rupees is our over recovery and will be added back to the adjusted profit. To understand the concept of absorption costing as well as two terminologies of under recovery and over recovery, let us have one additional practical problem. This problem is like this: you are provided the following information of X company limited and you are told to prepare income statement under absorption costing. Information is like this: direct material cost rupees 15 per unit, direct labor rupees 8 per unit, direct expenses rupees 2 per unit, variable factory overheads rupees 4 per unit, fixed factory overheads rupees 1,20,000, variable administration overhead 50,000 into bracket rupees 5 per unit sold, fixed administration overhead rupees 70,000, variable selling and distribution overheads rupees 60,000, rupees 6 per unit sold, fixed selling and distribution overheads rupees 90,000, selling price rupees 90 per unit, normal production 12,000 units, sales 10,000 units, opening stock 1,000 units, actual production 11,000 units. Let us have another option also. If your production is 13,000 units, will it be there any change in your profit? To explain the concept of under recovery, we will take actual production of 11,000 units, and to understand the concept of over recovery, we will take the production of 13,000 units. Since we are working for absorption costing income statement, so in this case the determination of recovery rate is essential. In our case, fixed factory overheads are given to us of rupees 1,20,000 and normal production is given to us of 12,000 units. Therefore, rupees 10 per unit is our recovery rate. Number 2, here we have to undertake the computation of closing stock, because we are given two situations where 11,000 units production is given as well as the production of 13,000 units is given. Let us take first of all the case of 11,000 units where production is less than normal production units. Here we will prepare manufacturing accounts in units. We have opening stocks of 1000 units, production of 11,000 units, sales of 10,000 units. Therefore, difference of 2,000 units will be treated as closing stock. Friends, as it is told, this is the case of under recovery because our normal production is of 12,000 units while we have undertaken the production of 11,000 units only. Therefore, actual production of 11,000 units is to be multiplied by recovery rate of rupees 10, that comes to rupees 1,10,000. On the other hand, our actual fixed factory overhead is of rupees 1,20,000. Therefore, our recovery is less than our actual cost. So, we will have case of under recovery of rupees 10,000 and this will be deducted from our unadjusted profit. Now, let us take the case of over recovery when our actual production is greater than normal production. In our illustration, we have considered the production of 13,000 units. Our opening stock is of 1,000 units, production 13,000 units, sales would remain same 10,000 units. Therefore, our closing stock will be 4,000 units. As we have discussed, this is a case of over recovery. Now, let us take the case of over recovery where actual production is greater than normal production. In our illustration, we have considered the production of 13,000 units also. Opening stock would remain same 1,000 units, production 13,000 units, sales also would remain same 10,000 units, but our closing stock will be of 4,000 units. This is the case of over recovery. Here our recovery rate is rupees 10 per unit, while actual production is 13,000 units. Therefore, recovered overheads are of rupees 1,30,000, while our actual fixed factory overheads are of rupees 1,20,000. Therefore, it is a case of over recovery and rupees 10,000 will be deducted from our non-adjusted profit to arrive at adjusted profit. Now, let us prepare income statement under absorption costing where our normal production is of 12,000 units while actual production of 11,000 as well as 13,000 units. Let us see this income statement. In income statement, both production levels are shown, production of 11,000 units which is a case of under recovery and the production of 13,000 units which is a case of over recovery. Sales would remain same, that is rupees 90 per unit multiplied by 10,000 units, rupees 9 lakh. Direct material rate would remain same, direct labor, direct expense, variable overheads and fixed factory overhead. Here recovery rate we have already calculated rupees 10 per units. So, direct material rupees 15 per unit multiplied by 11,000 units and 13,000 units, total will be shown in the statement 1,65,000 and 1,95,000. Direct labor rupees 8 per unit multiplied by 11,000 units and 30,000 units. Consequently, figure will be 88,000 and 1,04,000. Direct expense is rupees 2 per unit, 11,000 units, 13,000 units, amount 22,000 and 26,000. Variable factory overheads rupees 4 multiplied by 11,000 into 13,000, 44,000 and 52,000. Fixed factory overhead rupees 10 per unit multiplied by 11,000 and 13,000, 1,10,000 and 1,30,000. Cost of production will be 39, get the total of 15, 8 rupees, 2 rupees, 4 rupees and 10 rupees will be multiplied by 11,000 and 13,000. Finally, cost of production in the first case our production is of 11,000 units and in the second case our production is of 13,000 units. Now, this will be multiplied by per unit cost which is arrived rupees 39 per unit. So, 11,000 unit will be multiplied by rupees 39 and 13,000 units will be multiplied by 39. Finally, we will have answer of 4,29,000 and 5,07,000. This figure is your cost of production of 11,000 units and 13,000 units respectively. Here we have opening stock which is identical in both the cases 1000 units multiplied by rupees 39. Then after the whatever amount is arrived 4,68,000 and 5,46,000 respectively for both the cases, from this closing stock will be deducted. Here the units of closing stock are different in the first case and in the second case. In the first case we have closing stock of 2000 units, while in the second case we have closing stock of 4000 units. But the cost per unit would remain same, will be multiplied by 2000 units for first case and will be multiplied by 4000 units in second case. Finally, from this 4,68,000 and 5,46,000 rupees, we have to deduct the value of closing stock, that is 78,000 and 1,56,000 respectively for first case and second case. Finally, the cost which we will get 3,90,000 rupees, 3,90,000 in both the cases is the cost of goods sold. This amount will be deducted from rupees 9 lakh and we will have our non-adjusted profit is arrived at rupees 5,10,000 and 5,10,000 in both the cases. Now, this is the case of under recovery and over recovery where we have considered actual production of 11,000 units and 13,000 units. On the other hand, our normal production is of 12,000 units. Obviously, our first case will be of under recovery. Here we have less production of 1000 units. So, 1000 unit will be multiplied by 10 rupees of recovery rate and this 10,000 rupees will be deducted from our profit. Then after we have over recovery of 1000 units in the second case will be added in our profit and therefore, our adjusted profit would arrive at rupees 5 lakh and 5,20,000 respectively for the production of 11,000 units and 13,000 units. Now, to arrive at net profit, we have deduct our all non-production cost. Variable overhead to be deducted, fixed administration overhead to be deducted, variable selling and distribution overheads to be deducted and fixed and selling distribution overhead are to be deducted. The sum of all these figures comes to 2,70,000 and 2,70,000 will be deducted from adjusted profit from 5 lakh rupees. So, in the first case we will have net income of 2,30,000 and in the second case again 270 will be deducted from 5,20,000. Our net income, that is earning before interest and tax, will be 2,30,000 and 2,50,000 respectively for production of 11,000 units and 13,000 units. We have got familiarity about absorption costing. Now, let us have information on marginal costing. What is marginal costing? It is that kind of costing system where only variable production overheads and direct costs are to be taken into account. Here, direct material, direct labor, direct expenses and variable factory overheads will be considered to arrive at production cost of a product or service. In the initial stage of this chapter, we have taken information about direct cost and indirect cost. Here, the question is of cost determination of product and services. But which cost? Production cost. How to determine production cost under absorption costing and marginal costing, that is the important part. We have already acquired the information about absorption costing to determine the production cost of a product or service. Now, we will acquire information how to determine the product cost or service cost under marginal costing system. There is only one basic difference, that fixed factory overheads are considered in case of absorption costing, while in case of marginal costing this will be ignored and only variable factory overheads will be considered. Income statement under marginal costing. Particulars rupees, sales, selling price multiplied by number of units sold, less cost of goods sold. Components are as follows: direct material rate per unit multiplied by number of units produced, direct labor rate per unit multiplied by number of units produced, direct expenses rate of unit multiplied by number of units produced, variable overheads rate per unit multiplied by number of units produced. Finally, we will get the cost of production. Here if you have any, value of opening stock will be added and the value of closing stock will be deducted. This total figure will be deducted from the sales value to arrive at gross contribution. From gross contribution, we have to deduct remaining two variable overheads, that is variable administration overheads and variable selling and distribution overheads. The final figure which will be arrived is known as net contribution. From this net contribution, we have to deduct all kinds of fixed overheads, that is factory, administration, selling and distribution. Finally, the remaining figure will be treated as net income, or it may be called as earning before interest and tax. Marginal costing is known as variable costing system also. Here only variable production costs are considered. No fixed factory cost is included, so no need to calculate any kind of recovery. Therefore, the computation of under recovery or over recovery would not arise in this case. This is applicable only in case of absorption costing. Now, let us try to understand the income statement under marginal costing system when we have production of 11,000 units and 13,000 units, against which we have normal production of 12,000 units. Sales is rupees 9 lakh, from where we have to deduct the cost of goods sold. Direct material 1,65,000, 1,95,000, direct labor 88,000, 1,04,000, direct expenses 22,000, 26,000, variable factory overheads 44,000 and 52,000. Now friends, you recollect the memory of your previous income statement where we have considered fixed factory overhead, while in this case here we have ignored fixed factory overhead, only variable factory overheads are considered. Therefore, now our production cost will be rupees 29 per unit for 11,000 unit and 13,000 units. You recollect your absorption costing statement where our production cost was rupees 39 per unit with the inclusion of fixed factory overhead. Now, here our opening stock will be calculated rupees 29 per unit for 1000 units for both the cases, and from that we will deduct the value of closing stock for 2000 units and 4000 units respectively for the production of 11,000 units and 13,000 units. Here our sales will be 10,000 units, 10,000 units in both the cases. Our production cost is arrived 2,90,000, 2,90,000 in both the cases. Therefore, our gross contribution is 6,10,000. From this gross contribution, we have to deduct variable administration overhead at rupees 5 per unit and variable selling and distribution overheads at rupees 6 per unit. 50,000 and 60,000 will be deducted from both the cases, and therefore, this will be deducted. After having this, 5 lakh rupees will be our net contribution. From this, we have to deduct our fixed overheads, all kind of fixed overheads, whether it is production or non-production overheads, meaning thereby is factory overhead, which is production one, but here in case of marginal costing, it will be treated as a only fixed overheads. Here no bifurcation will be done as a production or non-production. So factory overheads are to be considered over here, administration overhead and selling and distribution overhead. So total cost is of rupees 2,80,000 and 2,80,000. So income statement is showing net income of rupees 2,20,000 and 2,20,000. Now friends, one obvious question would arise in your mind, and that is about the difference in profit under both the system, absorption costing and marginal costing. When you have seen these two statements, perhaps you might conclude certain things from this statement. The point is consideration of factory overhead. Factory overheads are categorized into two parts, variable and fixed. When you see the absorption costing and you have determined the production cost, at that time you have considered 5 components: direct material, direct labor, direct expenses, variable factory overhead and fixed factory overhead. So obviously your cost will be higher than the marginal cost, because in case of marginal costing, we people do not include fixed factory overhead, only direct material, direct expenses, direct labor and variable factory overhead will be considered, where our production cost is 29 rupees per unit. So reason is the consideration of fixed factory overhead in case of absorption costing and not inclusion of fixed factory overhead in marginal costing. So that is the basic reason. Number 2 is, as we know, as per the norms of the financial accounting, that opening stock always shows debit effect, while closing stock always gives us credit effect. If the value of opening stock is higher, then obviously our profit would reduce, and the value of closing stock is higher, then obviously our profit would increase, and therefore there is a effect of opening stock and closing stock on the overall profitability under absorption costing system and marginal costing system. Let us try to understand this difference with the help of our calculated figures. Friends, we have two cases over here, when you have production of 11,000 units and when you have production of 13,000 units. Let us try to understand the profit difference under absorption costing and marginal costing when we have production of 11,000 units. In case of absorption costing, our profit is of rupees 2,30,000, while under marginal costing our profit is of 2,20,000 rupees. Our profit is excess in case of absorption costing by rupees 10,000. While when you have production of 13,000 units, under absorption costing we have profit of rupees 2,50,000, and under marginal costing we have profit of rupees 2,20,000. So we have excess profit by rupees 30,000 in case of absorption costing. Let us try to understand how this profit differences are arised in the form of account. Profit under both the system when production is of 11,000 units. This information is presented in the form of account, and both the systems are shown at the debit side and credit side. At the debit side, as per the norms of financial accounting, we have disclosed opening stock, and at the credit side we have disclosed closing stock. Friends, now we have two parties, absorption costing and marginal costing. Under both the system, we have profit. Under absorption costing system, we have profit of rupees 2,30,000, while under marginal costing, we have profit of rupees 2,20,000, and there is a difference of 10,000 rupees. Now let us try to find out why this difference is arised. As you were used to prepare reconciliation statement of cash book and passbook, in the same manner this reconciliation statement is to be prepared. Out of these two party, we had to assume one party as our own party, and the opposite party will be another party, and here we will write our own profit to commence the reconciliation statement. Then after we will find out the reasons due to which this differences arise. In case of absorption costing and marginal costing, there are only two reasons, that is valuation of opening stock and closing stock. Here we are assuming that our party is absorption costing, where our profit is of rupees 2,30,000. We will take the information about opening stock and closing stock. Here opening stock under marginal costing system is valued at rupees 29,000, while under absorption costing it is valued at rupees 39,000. Therefore, there is a debit effect of 10,000 rupees in excess under absorption costing. So our profit is reduced by 10,000 rupees. On the other hand, the profit of marginal costing is increased by 10,000 rupees. If the profit of marginal costing is increased by 10,000 rupees, we will also increase our profit by 10,000 rupees. And that's why here we will add undervaluation of opening stock of rupees 10,000 under marginal costing system. Therefore, our total profit will be of rupees 2,40,000. Now we will see the value of closing stock. Under absorption costing, value of closing stock is 78,000, while marginal costing has considered 58,000. So, there is a reduction in profit of 20,000 rupees in case of marginal costing, and now we will also deduct our profit by 20,000 rupees. So, here overvaluation of closing stock under absorption costing system. So, 20,000 rupees will be deducted from rupees 2,40,000, and finally we will get the profit under marginal costing system rupees 2,20,000. So, like this we have to identify the reasons, and under absorption costing and marginal costing we have only two reasons, and that is value of opening stock and closing stock. These two reasons are to be incorporated during preparation of reconciliation statement. So, our absorption costing profit showing 2,30,000 rupees, and after preparation of reconciliation statement we have profit of marginal costing 2,20,000. Friends, the terminology of profit is known to you. Profit itself is a dependent factor. There are several independent factors which are affecting the determination of profit. In financial accounting, there are two important components. One is sales value and number two is cost of production. But when we are observing absorption costing and marginal costing, at that time the determination of profit is influenced by two different factors, and for that we have to see the relationship between production and sales and their impact on profit. Here we will have three types of conditions. Condition number one, when your production and sales are identical. In the previous case, as we have studied, when there is a difference in the value of opening stock and closing stock, obviously there will be difference in the profit under absorption costing and marginal costing. But when your production and sales are identical, no question of opening stock and closing stock. If there is no opening stock, no closing stock, obviously there will not be any difference in profit under both the system. But when your opening stock is greater than closing stock, in this case profit under absorption costing will be less than that of marginal cost, because under absorption costing system the cost is always higher, and obviously due to opening stock the total cost would go up and profit would get reduced. In third case, when the opening stock is less than closing stock, in this case the profit under absorption costing will be higher than that of marginal costing system. Obviously you will have question in your mind, when these two different profits are determined, then what is the use of this kind of system? What is the role of absorption costing system? What is the role of marginal costing system? Friends, here we have to note that as a management accountant as well as a management, different types of decisions are to be taken. Out of these different categories, one category is based on the time period. There are two types of decision to be taken by the management. One is long time decision and number two is short time decision. As and when long time decisions are to be taken by the management, at that time absorption costing is to be used and it is advisable to arrive at total profit. But as and when short term decisions are to be taken, at that time absorption costing is not useful and marginal costing is highly preferred, and therefore these two system prevails in the system itself, and both are having relevance on the basis of time period. So far we have obtained information about absorption costing and marginal costing in detail. Now let us try to understand what are the important points which are creating the differences between these two systems, or let us understand the comparison between absorption costing and marginal costing. Let us see different criterias. First criteria is about consideration of fixed factory cost and production cost. When it is a absorption costing, fixed factory costs are very essential to determine the production cost. But under marginal costing, it is not included, it is ignored. Number 2 is stock valuation. The stock valuation is very important because the determination of profit is based on stock valuation. If your stock valuation is correct, obviously your profit will be correct. If your stock valuation is incorrect, your profit will be incorrect. But when you are applying the absorption costing system, at that time under valuation of closing stock, you have to consider the fixed factory cost, while under marginal costing system, it is not considered. Number 3 is about recovery rate. Under absorption costing, we have studied about recovery rate, and recovery rate determination is compulsory, while in the case of marginal costing, it is not required and not applicable. As and when you have recovery rate, obviously question would arise about under recovery and over recovery, and under and over recovery is a case for absorption costing and not applicable in case of marginal costing. When you are talking about profit, in case of absorption costing, two types of profits are to be determined. One is non-adjusted and second one is adjusted profit. While in case of marginal costing, there is no concept like profit. Here we have to determine gross and net contribution. Next, when we will see, it is about decision making. Decision making means that is short term decision, and when you are going to take short term decision, at that time absorption costing is not useful, but it is useful for marginal costing. And finally, when you are preparing the report from the viewpoint of reporting, absorption costing is useful for the external reporting, while marginal costing is used for internal reporting. So now in this manner, see friends, we have acquired sufficient information about absorption costing and marginal costing. Now let us summarize this information. In this module, we have studied two different methods to determine the production cost of product or service. These two methods are absorption costing and marginal costing. Next, we have studied the different components of production cost, where we have acquired information about direct material, direct labor, direct expenses, factory overhead, administration overhead, selling and distribution overheads. Which costs are included in case of absorption costing and which costs are included in case of marginal costing to determine the production cost, that also we have studied. Then another significant component of this chapter is about product cost and period cost. This information also we have acquired at sufficient level. Next point is about recovery rate, over recovery and under recovery, which is purely applicable in case of absorption costing. Subsequently, we have seen some practical problems on absorption costing and marginal costing. To understand perfectly, precisely these two income statement, we have prepared reconciliation statement also to know the different reasons why there are different profits under absorption costing and marginal costing. And finally, to understand the reasons of differences under absorption costing and marginal costing, we have undertaken the comparison also. I hope that this discussion will be useful to you people.